Everybody, welcome to March. Amazingly, we're already through that. Some big news over the weekend, so we'll dive right into that. And we've got some charts as usual, show you where we are and where we are headed. So the big news, the U.S.-Israel joint strikes on Iranian targets. Numerous leaders killed there, including the main Ayatollah for Iran. Iran retaliates, of course, and reported some U.S. casualties there. So things definitely to worry about geopolitically as we move forward. So what does that actually mean? Lots of talk about potential regime change. Our view is that that's unlikely to happen quickly anyway. We've seen that as you call it, decapitation, taking out the main leader, rarely stabilizes a regime. So there's a higher risk of fragmentation as opposed to a clean transition. But you're probably also going to increase the risk of civil war or civil conflicts in Iran more than, as we say, that swift change of the regime. So we'll see what happens there. Lots more news and headlines going to come out of this, I am sure. As far as the markets go, what does that mean? Really, it's an oil story. We've already seen oil prices spike. We've got a premium priced in for the geopolitical issues that we've seen. And this, of course, isn't the first one we've seen lately around oil. What could happen? Oil could continue to move up if there's more attacks, more targets on oil. There is a bit of an issue of a mutually declared destruction, if you will, if both sides continue to attack oil resources. And that's really what you need to get oil to move up into that $100 plus range. So we'll see what happens there. Seems unlikely that will happen, and that'll need to happen for a while. But we'll continue to see what happens. What does that mean for the overall markets? Really less impactful on the overall markets. We did see kind of the futures trade very negative with the uncertainty over the weekend. But as we're seeing even today, the first day of trading, markets open negative and have been moving more positive through the day here. So what does it mean on the overall markets? Those oil prices going to affect Europe and Asia more than the U.S. And the rest of North America. Of course, the U.S. has its own production, so can weather that a bit more. But if oil prices continue to move up, that is going to hit inflation in the longer term. Not massively so. You can see 30 to 40 basis points is kind of where they're guided to if oil prices stay up. But inflation is, of course, been a big story as global governments continue to fight with inflation, try to bring it down from the higher levels we saw coming out of COVID, which has, of course, been 5 or 6 years now. So if inflation continues to move up, then that could start to impact the global interest rate level. So again, that's a longer term thought, but that is where we could see some impact on the markets globally. Now, keep this in perspective. We've had a ton of geopolitical events historically. This chart's going back to 1900, so 125 years. You can see all the various events that have happened, where the markets have moved overall. Of course, some of these have caused dips in the market. Some have dipped before these events even occurred. And some dragged on longer than others to get back to all-time highs, but that is where the market always ends up, and this will be no different. So keep that in mind as you move forward and structure your portfolios. No need to panic on a geopolitical news, and as mentioned, the markets are already pricing that in. Here's another outlook on how the markets have reacted. You can see it through 1 month, fairly split as to whether the markets are positive or negative, which can be a bit surprising for some to see. You'd expect more negativity early on through these geopolitical events, but 46.5% of the time markets are positive 1 month later. And of course, if you look out 3, 6, and 12 months later, closer to 65% of the time, or 2/3 of the time, markets are higher. So good to see there. There are some big negative years, so keep that in mind, but also some positive years there. So the median actually 7.4% higher 12 months later after a geopolitical event, major event like this. So keep that in mind. Structuring portfolios, again, not something to panic about. Looking at the calendar, taking the geopolitical aside, over the last 20 years or so, we've seen this kind of early dip. Of course, last year we had Liberation Day, caused the end of March and beginning of April a bit of a dip there. Uh, but you can see over the last 20 years that really the second half of February, first half of March have been the weakest of the year, and where the markets have bottomed out for the year. So we'll see if that trend continues. And if so, then any sort of dip in the next week or two would be an attractive entry point as the markets end up on average 10.4% higher every year there. So see if that pays off. And why this year could that be the case, that the markets are going to continue to move higher despite all the negative news that we continue to see in the headlines? Here's your earnings per share, and the expectation going forward. You can see that just continues to grow here. So we had a dip in 2020, which is for obvious reasons there, but you've seen the markets continue to move higher, and you've seen companies' earnings growth continue to move up. And as you can see in 2027, the estimate there, much higher earnings growth for companies going forward. So that's a good sign, and a reason why markets could continue to move up. Now, last chart, always want to throw an interesting one in. We've talked about diversification a ton, globally diversified, different asset classes, kind of try and smooth out your investment line. We've talked about those big 7 tech companies and how much of a weight they are, 35-40% of the S&P 500. You can see them. This again is only a 2-month chart, so keep that in mind. You can see international stocks leading the way there, 10.6, and on the other side, down 5.5%, are those big 7 tech companies, those magnificent 7. And really, you put all that together on the U.S. market and how much of a weight they are in the S&P 500. That S&P 500 only up 0.8% for the year to start the first 2 months here. So a real drag on the markets. Exact opposite of what we saw 2 years ago, which is the case, as you never know which is going to outperform which in the short term. But you can see small cap, mid cap, value stocks all outperforming over the last year or so, and especially over the last couple of months. So keep that in mind. Build those portfolios well diversified. Need help with that? Just let me know. We'll be back with more videos, I'm sure, as news continues to unravel here. And we look forward to sharing some news with you on the next video. Take care.